Good day, everyone. My name is Alejandria Nika Sadaya from 11 ABM. So today, I will discuss the key elements of changes in equity.
The Statement of Changes in Equity reports changes in the equity ownership's accounts for a corporation. Equity can be defined as the worth or the value to the owners of the company, like the income statement. This statement reports for a period of time and it includes total comprehensive income that includes the profit or loss, the effect of changes in accounting policies, the correction of any errors that the company made, the amount of additional money invested by owners during the period, the amount of dividends distributed to shareholders during the period. Remember that the items most commonly seen in this statement are retained earnings or losses, which will either increase or decrease equity, dividends paid to investors, and withdrawals made by owners, both of which will decrease equity.
So let's move on to the form of business and organization management and its advantages and disadvantages. There are three types of business organization and these are the sole proprietorship, partnership, and corporation, and these types are different from each other. Firstly, I will explain the sole proprietorship definition and its advantages and disadvantages. The sole proprietorship or single proprietorship, only one person owns a business, but not naturally that he's the one to work. He can hire employee. It's to correct you, it's about ownership, not how many people are there. When it comes to partnership, it is two or more people combining all of their assets or resources. How many income results? They will divide the profits amount among themselves. Lastly, the corporation. Corporation is the ownership is divided into shares of stock, so it depends on how many shares you handle in that corporation. So let's forward to the advantages and disadvantages of the three forms of business organization. First advantages of sole proprietorship is it is easy for anyone to set up a business no matter how few assets or how little money you're starting with. Every business has to start somewhere, and many of the corporate giants we see today started out as tiny sole proprietorships. The second advantages of sole proprietorship is fewer taxes. Fewer taxes, that dreaded word, but when you have a sole proprietorship, that word may not strike as much fear in your heart. You'll report your business profits as personal income, meaning you'll be paying your personal income tax rate as opposed to a higher corporate tax rate. Third is greater flexibility and freedom. Being your own boss is one of the many upsides of running a sole proprietorship. You have the last word on all decisions. You decide what to spend and when to spend it. You choose what to do with the business profits. In short, you call all the shots. While the disadvantages are the owner of sole proprietorship rarely take holidays. Second is making day-to-day business decisions go in the hand of businessman. Third is that the owner is tasked as a single person. And lastly, the law under sole proprietorship does not distinguish between the personal assets of the owner and the assets of the business. His life gets limited around business. So let's forward to the advantages of a partnership. First is shared expertise and workload. With a partner, you have someone to bounce ideas off and who can complement your skill set with their own. This can lead to better decision and making a more well-rounded business. Increase access to capital. Two or more people can contribute financially to the business, allowing you to start with a bigger budget or take on larger projects. Easier set of management compared to a corporation, partnership have less complex legal and administrative requirements. This can save time and money. Finally, potential tax benefits. Partnership profits pass through to the individual partner tax returns, avoiding double taxation on business income. First example of disadvantages in partnership is unlimited liability. Unlimited liability. This means that each partner is personally liable for the debts and obligation of the business, even if they were incurred by another partner. Second, potential for disagreement. Having different personalities and goals can lead to conflict among partners. The third disadvantage of partnership is shared decision making. Important business decisions require agreement from all the partners, which can slow down the process. Finally, profit sharing. Profits must be shared among the partners according to the partnership agreement. So let's proceed to the final form of business, which is corporation. First advantages of corporation and business management is limited liability. Limited liability shareholders are not personally liable for the debts and obligation of the corporation beyond their investment in the company. Second is access to capital. Access to capital corporation have the ability to raise large amounts of capital through the sale of stocks and bonds. Third, perpetual existence. A corporation has a continuous life independent of its shareholders, which allows of long-term planning and stability. And lastly, tax benefits. Corporation may be able to take advantage of certain tax deduction and credits that are not available to others. The disadvantages of corporation in business management is cost and complexity. Setting up a corporation involves significant cost and administrative requirements such as filing fees, legal expenses, and compliance with regulatory standards. Second disadvantages is double taxation. Corporations are subject to corporate income tax on their profits, and then shareholders are taxed on any dividends or capital gains they receive from the company. Lastly, lack of flexibility. Corporations are often less agile and responsive to changing market conditions compared to smaller, more nimble structures. So let us now proceed into our last discussion, which is we will identify on how to construct a statement of changes in equity. In a statement of changes in equity, we would start the beginning and then we add any additional investment by the owner, then the net income. The net income comes from the statement of comprehensive income. If any net loss, we would deduct it as well as withdrawals made by the owner, and that will give you your ending capital balance. And again, the ending capital is the beginning capital of the next accounting period.